of credit and real estate today. I am Kevin Lewis, the owner of Parisian Credit Counseling, along with my good friend, the owner, Abigail Bridgeford, the owner of General Property Solutions Real Estate.
Hello, everyone.
And as you know, second Friday of every month, the year of our Lord 2023, we are doing a session on credit and real estate. Today, I am doing a conversation about business credit. And we started that conversation last month with the introduction of the phases of business credit. And for us, there are 5. We started with the phases of business credit. First phase being business legitimacy and how to establish yourself and make yourself appealing as a business owner to a creditor and or lender. Today, we're going into phase 2, which is where you actually start building your business credit. You start establishing and building your business credit. And that is the vendor phase. So if you'll do me a favor and go to the next slide. So want to back up and talk about true business credit, because this is the first place. This phase 2 is where you'll actually start filling out applications for business credit. And you'll know you're filling out applications for true business credit. And I underline true because a lot of times people are applying for business credit cards and they get to a credit card. You can put anything you want on the front of a credit card. So some people are applying for personal credit cards, but putting their business names on them, and they are believing that they have a business credit card. You will know that it is true business credit because on the application, if you are asked for your EIN first on the application, when you're going down, name, EIN, address, if you're asked for your EIN first, then you are applying for business credit. If it asks for your social security number first, then you are applying for personal credit. And again, you can put on a credit card, you can put whatever you want. So just be aware of that. But just because the application is asking for your social security number does not mean absolutely that you are personally guaranteeing or you're applying for personal credit. The Patriot Act was brought into existence after 9/11. And what it does is it tries to thwart terrorist activities and the funding of such. And so many applications are going to ask for the business owner's name, address, social security number, and date of birth. That's just for identification purposes. I mean, it doesn't mean that you're applying for personal credit. It just means that they're trying to verify that you indeed are the owner of this business. All right. So, but filling out the application, make sure if you're putting your EIN first, you are definitely applying for business credit. And this is a very important point. You can get business credit without a personal guarantee, and I'm going to show you how to do that right now. And again, this is what I alluded to just a few moments ago. The Patriot Act requires the lenders to ask for social and date of birth. All right. So now let's start with phase 2. For us, it's phase 2. Now, any company, any organization that helps you establish and build business credit is going to use the exact same process. They may break their process up into different steps from ours. We call ours phases, and we have 5 of these phases. This is phase 2. Again, phase 1 is what we talked about last month, which was the business legitimacy. Phase 2 is where you establish the business credit, and that is called vendor accounts. Now, whenever I talk to my clients, Amber, about vendor accounts, most people think about they've been in business, they've bought things from people, suppliers, and they think that all of their suppliers are giving business credit. That is not true. That is not true. Vendors are any companies that give, use the term, this is air quote. They sell products and services on credit and then invoice you for those products and services. That is what a vendor is. And there's going to be a difference between, we're going to talk next month about what we call it merchant credit, but you guys will know it as retail credit. That's what separates vendor credit from retail or merchant credit, is the fact that these vendors are going to sell the products, services, and then invoice you for the products and services. A retailer is not going to invoice you. They're just going to put it on credit, and you have to pay the credit however you pay. But the vendor is going to invoice you and then give you terms that you have to pay within. They can be booked back. So they can be net 30, net 60, net 90, et cetera terms. That number behind the net is the number of days past the date of invoice that you have to pay the entire invoice. That's what makes a vendor a vendor. They are going to invoice you, they're going to give you terms, and then you have to pay the full amount in those terms. So if it says net 30, that means you have 30 days from the date of invoice. That 60 is 60 days, 90 is 90 days, so forth and so on. And there are vendors that can give you terms 365, net 365. There's net 760. That means you have 2 years. It depends on the vendor. So people who, I'll give an example of people who live in rural America and are buying farm equipment. Sometimes they will give you the John Deere tractors. John Deere, endorse, but John Deere is a vendor in some instances. They give out invoices for their equipment, and they might do 3-year terms. They might do 4-year terms. It's always going to have a month or a number behind there that is in months, or I'm sorry, days, not months, not months, in days. Now you look like you have a question.
A question I want to ask is, what advantage would it be to the companies to have such a long period of time in which they have to wait to get their money back?
So it may not seem advantageous for the common company, and it wouldn't be advantageous for the common company. But a company like John Deere, you can imagine they have billions of dollars worth of tractor equipment that they're selling, right? And they finance equipment. So they're making a lot of money on the interest. So they can carry terms for some of their clients, customers. John Deere has customers, we have clients. They have customers. So they can carry those terms for those customers because they're making the money from their other customers, right? You don't see it very often. But it can happen. But what I want to point out is the number behind there is the number of days past the date of invoice that you have to pay in full. Paying in full. Now, the wonderful thing about business credit is this next piece. So, looking at an invoice, the earlier you pay an invoice, the better your business credit is going to be. The earlier you pay your invoice, the better your business credit is going to be. So, Siobhan, let's say you have a personal credit card. Doesn't matter what the company's name is. Let's say you have a personal credit card. If you pay your credit card early, do you get any points for that? No, you don't. But in business credit, you do. The earlier you pay, the more points you're going to get. If you pay an invoice, let's say you have a net 30 invoice. If you pay that invoice on time, now business credit is not scored, it's rated. The higher, there is a number, however, but those numbers are associated with letters, just like, and they are the numbers that are associated with the letters are just like when you're in school. So from 90 to 100, a paydex score, which is the business equivalent of a FICO score. The paydex score is actually called a paydex rating, but the scoring system that they use is just like school. So if 80 to 90 is going to get you an A rating. my apologies. 90 to 100 is going to get you an A rating. 80 to 89 is going to get you a B, so forth and so on. I don't have to keep see where I'm going with that. Okay. If you pay on time, you're going to have a C rating. So that's going to be 70 to 79. If you pay 7 days early, you're going to have a B rating. In other words, so let me ask you a question, Amber. If you have a net 30 invoice, how many days do you have to pay to get a B rating?
I can cheat, right?
You can cheat.
Okay. Well, this is an open book test and paying 7 days early.
So 7 days early will get you a B rating. That's correct. So you have an invoice that was on, because this is a several part question, right? You thought I was gonna let you off the hook. Several part question. You have an invoice. The invoice was given to you on August 1st. In order to get a B rating, when do you have to pay? What date in August do you have to pay that invoice?
Before August 1st?
No,
was
the
given
invoice
to-
came on August 1st.
It was
So
given to
you
me.
have 30 days from August 1st to pay the invoice in its entirety.
August
What?
23rd?
August 23rd, so around August 21st, I'm sorry, August 23rd, you're right. August 23rd, you have 30 days. So you're 100% correct. August 21st to 23rd is right about when, because they back out some days, depends on the month.
Well, August has 31 days,
It
right?
has 31 days, but the invoice has 30 days. So doesn't matter how many days are in the month. February is a little tricky. Doesn't matter the month days though. It only matters the date of invoice. So if it's February 1st, you're gonna have 30 days from February 1st. But in this case, you're right. On the 23rd is when you can get a B rating. Now you have up until the 30th to pay that invoice. So if you pay it 14 days or more early, you'll have an A rating. So we tell people, you get whatever your invoice, if it's net 60, net 90, just pay it at least 14 days early, and you'll have an A rating. Now, here's the greatest thing about business credit. The greatest advantage of business credit versus personal credit. You guys heard me talk about this when I talked about personal credit in the early stages, in month 3. In personal credit, let's say you paid a credit card 30 days late. So it was late by 30 days. You're going to have a hit on your personal credit report of 30, 40, I've seen 50 points, depending on what you paid late. If it's a mortgage, I've seen it drop 60 points, right? Don't pay your mortgage late. Don't pay your mortgage. Don't buy a condo. But anyway, so in personal credit, your score drops. Let's say it's a credit card. You pay that credit card 30 days late, which is one cycle, right? You pay it one cycle late, your score is going to drop. It could drop 30 points. It's going to take you 24 months or 2 years to get those 30 points back. And you have to pay that. You have to pay it on time. You can't. Again, Siobhan, if you pay it early, do you get any extra points?
On personal or
On personal.
No.
You do not. So you can pay it early for the next 24 months, not going to matter. So you might as well just pay it on time, just not late. But it's going to take you 24 months to get those 30 points back. But in business credit, I told you how to get an A rating, pay 14 days early. So you got to get a B rating, pay 7 days early. So you got to get a C rating, paying on time. But what happens if you pay late? Let's say you pay 2 weeks late, right? So 2 weeks early, you'll have an A. But if you pay 2 weeks late, so you pay in 44 days instead of 30, what's going to be your rating?
F.
F. You're going to have an F rating. Because F is attached to points, right? So you might drop, now you don't drop the same amount of points, you might drop 10 points, 15 points, 20 points. 20 points is about the max I would see. So your score, your rating is going to drop to an F, you're going to lose 20 points. This is the wonderful thing. This is how you get those. So you paid that invoice 14 days late. All you have to do to get those points back is the next invoice you get. It doesn't matter where you get it. The next invoice you get paid 14 days early. Your score will go right back up. So if you lost 20 points, you're going to get 20 points right back. So in essence, you could lose 20 points and regain those 20 points in the same 30-day cycle. As long as you're paying that invoice. And it doesn't matter what the invoice is, because in business credit, they take the average payment time of all of the trade lines that are reporting on your business credit profile. So let's say, let me endorse here. I'm gonna endorse, I'm gonna put some names out. So let's say you have Quill and Uline, because those are two very popular vendors. So let's say you have a Quill account and a Uline account. Those are the only two things on your credit. And you pay your Quill bill 14 days late. But you don't need anything from Quill. But you need something from Uline. So the next time you order from Uline, you pay your Quill bill late. The next time you pay Uline, you just pay your Uline bill early and you'll get those points back. Doesn't matter that you lost it from Quill. That's the other thing. That's the other thing. In personal credit, the credits don't mix. You have a late payment on credit one. Capital One is, if you pay Capital One early, Credit One is not going to give you credit for that. But in business credit, they do. This is good. This is credit. Personal credit. Yeah. It's okay. We need it, so don't abandon it. We need it. All right. What is important to note about vendors is not all vendors report to the business credit bureaus, and the ones that do report may not report to all of the credit bureaus. So let's talk about the credit bureaus. This is not up there. So people paying attention online and in the room, there's some stuff that's not up here that you may want to jot down. So there are several business credit bureaus, but they rank in order of notoriety, notability. Paydex or Dun & Bradstreet is the most notable and the most heavily weighted of the business credit bureaus. Behind Dun & Bradstreet, by the way, Dun & Bradstreet is who gives you the actual Paydex rate. Behind Dun & Bradstreet is Experian Business, separate, totally separate from their consumer division. Experian Business, they give you an SPSS score. And it equates to a rating as well. And then Equifax Business is the third, and they give you an Equifax Business score. Again, it is rated, not scored. They'll give you a rating as well. Those are the three most notable, and then there's Credit Safe, and there are a few others, but they're not widely used. Those are the three most widely used business credit bureaus. Not all vendors report to those. So Abby, you might be using we're calling them vendors, but most people may call them suppliers, right? You may be getting your printer paper from a supplier. That supplier does not have to report to the business credit bureaus. Now, this is the difference between personal credit and business credit. Most personal credit is reported to the credit bureaus, but most business credit is not. Yes.
It is not, you requested.
Absolutely. Absolutely. That's a great question. The question for those of you who didn't hear it was, if you have a supplier or a vendor, we call them vendors. If you have a vendor that is not reporting to the business credit bureaus, can you ask them to report? The answer is yes. Many times they will, sometimes they won't. They may just say we don't, because it costs them money to report, but they may be willing to do it for you, but you have not because you asked them. So ask, if you're currently using a vendor, ask if the vendor reports. If so, who do they report to? I know that's a dangling participle. I learned that in English back in elementary school. I didn't forget it. It's a dangling participle. So it's properly said, ask to whom do they report? See, Mom, you'll be proud of me. All right. So ask to whom they report, how often. Try to get all of your vendors to report your payments to the business credit bureaus, because the more any credit that goes on business credit reports is called a trade line. The more trade lines you have, the better it is for you, the more credit you can get. So ask them if they report to the business credit bureaus, and ask them if they report to all of them. They tell you no, we'll only report to one. Hopefully they report to Dun & Bradstreet. And then if you do not have a vendor that's reporting, then go out and get them. There are plenty of vendors out there, and if you come see us at Parisian, we can tell you which ones to use. But there are plenty of vendors that you can buy products and services from that report to the credit bureaus. We know they report to the credit bureaus. Okay? Make sure you find out who they report to. All right. All right, here's the mechanics of how to establish a vendor account. Apply for vendor accounts from the companies that we use, or again, ask your vendors. But this is important. You want to have at least 4 vendors reporting to the Business Credit Bureaus. And if you can get them to report to Dun & Bradstreet, Equifax, and Experian, or Dun & Bradstreet, Experian, and Equifax as it were, then that's better for you. Get at least 4 of those reporting to all 3 of the bureaus, and order $75 or more worth of products or services from them at least. I have found that if you order less than that, a lot of times they don't report those things. And then choose net 30. Most of the companies are going to use net 30. Okay. Once you have paid, you will have established your paydex score called Business Credit Score. And then this is extremely important. That's extremely important. Before you move on to our next phase, which is called merchant credit for us, but retail credit for you guys, before you move on to the next phase, wait 90 days. The reason, on what? I didn't expect you to know. So you want to wait 90 days because business credit is different from personal credit in its reporting. It takes a lot longer for them to report because a lot of companies do batch reporting. So they wait until they may have 100,000 customers. They may wait until all 100,000 customers have paid invoices before they report all of those 100,000 accounts to the Business Credit Bureaus. So it could take 90 days. It could take 90 days before you see your payment show up for the Business Credit Bureaus. And you don't want to move on to the next phase until those things start showing up, because they're going to use those things to determine whether they're going to grant you credit and how much they're going to grant you. Next thing. Questions, concerns, issues, commentary, comedy show.
If there's a situation where you said choose net 30, but perhaps because you have several vendor accounts, can you ask them to be on net 60 just so that all your accounts are not due all at the same time?
Absolutely,
Okay.
absolutely. You can ask them for any net terms you want, and many of them are negotiable.
Oh, okay,
Many of them
that's
are
really my
negotiable.
question, like how negotiable are vendors?
Many vendors are negotiable because it depends on, again, it depends on the size of the vendor, right? A vendor that only has 1,000 accounts and doesn't charge interest, they don't have a credit card. So let's look at again, I hate to endorse, but let's look at Quill, for example. Quill has hundreds of thousands of accounts, and they do a charge card. Now, they didn't used to. So they're getting interest rate from their charge cards. They can afford to take it out 60, 90 days. They may not, they don't have to, they may not. But a small company that has 1,000 clients, doesn't have a charge card, may say, we need to get our money as soon as possible. And if you are in business, which you should be if you're having this conversation or considering it, you're going to be looking at your 3 financial statements, the income statement, the balance sheet, and the statement of cash flows. Your balance sheet is going to show people who are paying you or who owe you money and people you owe money to. And so if you are that's a great question, Abby. How I would tell you to use this is really important. How I would tell you to use this is a great example is a landscaping company. Let's say there's a landscaping company and the landscaper gets paid. They are on average collecting their money at 180 days, which is 6 months, right? Carry 6 months. So they are collecting their money from their clients on an average of 6 months. They don't want to be paying their vendors on 30 days. They want to be doing 180 days as well, because they don't want to be paying out money and not collecting money. So that's that's an instance where we would be great to negotiate the net terms. All right, anything else? My good people, it's been a pleasure and honor. Once again, I see the floor.
Oh, wonderful. Like to thank you, Mr. Edmund Lewis, for the credit that was down to our viewing audience, those in the room. It's a lot of information. We understand. A lot of information. So we were able to review this information on our YouTube channel and on Facebook. It's sure Mr. Edmund Lewis is going to be posting, because we might want to review this information, go back and just look at your own personal set of circumstances, see how this information if it better help you. Again, I'd like to thank the Free Library for the opportunity for credit and real estate today to use facilities to be a service to the community, because we understand how valuable this information is, especially to area or communities that shows a lot of disparity. So today, what I'm going to do is I'm going, while we're waiting for the slide, I'll do a little exercise with you all, memory exercise actually, if you don't mind. I had this happen to this past Sunday, something similar was done, and I thought it was very interesting, and I wanted to try it on the audience here. I'm sorry. So our memories, I want to see just how well you can remember something. Now, try this exercise a couple of times with some of you in the room. But for those who haven't tried it before, let's do something different. I'm going to give you 12 letters, just 12. And I want to see, can you remember all 12 letters? Okay?
In order.
In order. Okay, FB, IC, DC, PO, AL, OF. You want to remember those letters, 12 letters in order? Yes, let's try.
FD,
Wrong.
I'm sorry, FB,
Okay.
DIC.
Nope. The answer no. Just the, isn't the exercise. The reason I chose this exercise is because 12 letters is not a way to say that you have a bad memory. Not at all. Not to say you have a bad memory. What the exercise allows us to do is to try to see things a certain way. So what I'm trying to do for the audience is to see things a certain way. So I'm going to give you the same letters, okay? And tell me if you can remember these 12 letters, okay? FBI, CDC, POA, LOL.
Oh.
So can we remember those 12?
Mm-hmm.
Okay, let's try it. I'll give you the 4 again.
FBI, CDC, BOA, LOL.
POA.
POA, I'm sorry, POA.
Now, the same 12 letters, which I'm going to put on the board for a minute, and you'll see where I'm going with this eventually. Probably saying like, why is Abby bringing up a bunch of 12 letters? And why is it that we're doing this exercise? And today our subject is going to be owning real estate in the business. All right, so FBI, CDC, POA, the LOL. When I said the letters to you originally, I said it in twos. Right?
Mm-hmm.
When I said it in twos, it did not allow your brain to really be able to catch it all, because it's like it feels random to you. But when I said the same letters in threes, this will illustrate for its own. Your brain and your mind connected to it. It was relatable. It was something that you could say, oh, I know what that is. I'm familiar with it. Well, with business real estate, with business ownership, let's say, it might feel a little awkward, might not be something that's relatable, but it's always existed. It's the same 12 letters. So we're buying real estate in a name or as a single person or in a business. Same elements, let's say, but we want to see it, have our mind see it somewhat different. Okay, so I'm going to pull up and I'm going to officially welcome you to buy real estate as a business. Okay, I'm not trying to dumb down anybody. What I am going to do, I found out that because our audience varies in education levels, we have to make it clear everyone understand what we're talking. So when we look at our next slide, do that. What is a business? Because people say, well, you know what a business is. What? No. Some people do not know what a business is. So, business is defined as an organization or enterprise and entity engaged in commercial, industrial, or professional activities. So if you are an individual who are interested in buying real estate as a business, you do not consider a hobby, something that you just do on the side and make dollars. That is not a business. A business is something where you are doing this with the primary focus of earning money and potentially obviously seeing profit. So when we buy real estate, there's a lot of things that we look for on, because most of us are used to seeing things, buying our house, getting personal credit, as Kevin mentioned. Then there's business credit. It's two different entities. So when we look at our next slide, what I want to take into consideration, that's okay. Because today we have a lot of information. So business is a very general word. What I need for you to do is think differently, as we did with our illustration, about who and what you are. So the word entity, okay, entity. Abigail Bridgeford is an entity. Sole proprietor. It's just the entity. Another entity, which is different, would be our next general partnership. The other entity or structure of business is limited liability corporation and then corporation. Because of time constraints, we're not going to talk about all of them. We'll discuss the first three today, because the last one is going to have to be another time. However, what we need to do is, I want everyone to take a moment to look at or think about what they're trying to accomplish, and then which of these entities your business should take so that you can reach your goals. Now, Kevin and I, we talk to a lot of people in general, think of the here and now. We like to encourage them to think about future generational goals. Don't think about just your initial investment. Think about what it is that you want to do long term. Real estate can have a very long lasting financial effect if you let it. But that's another conversation, right? So this is not going to be one of those discussions where we talk about each and every one of these in terms of what you should do, what you shouldn't do. This is all just information we're going to put out there. And if you want to discuss any of this information with Kevin and I after the sessions, you will have our personal information and be able to. So let's get into our first sole proprietor. Now, the sole proprietor, when you buy real estate as a sole proprietor, what we want people to understand is this. That sole proprietor means one person owns the business. Generally, the sole proprietor is you. Okay? You are the business. When you're buying real estate, what the real estate office, well, in general, what we do is we find out a little bit more about you, whether you want the business in your name, because the sole proprietor is you, or do you want the business in the name, or the real estate in the name of your business, which is the case with all of these businesses. So let's look at some of the pros. When you're filing your income taxes and you buy real estate, it's easy. It's quicker tax preparation. There's no real question about it. The 1099 comes in as the name of your business on it, and you can file it on your income tax return. Usually with a sole proprietorship, it's very little expense, if any, to start a business. You don't even have to have really the real documents. You sign up with the local cities, you can pay your local taxes, but it's not much of an expense as it comes to being a sole proprietor. And it gives you the flexibility and liberty to say, you know what, I started this business today. I don't feel like, you know what, I'm done. You know, who would know? You're a sole proprietor. The business is you. So you have a little bit more liberties and flexibility to say what you want to do. You don't have other people weighing in on decisions because you are the business. So when buying a property on the contract, you will sign all the documents, but you are the business. There's no separation at all. Okay. Let's talk about some of the cons. One, anything goes wrong. Who would it all fall? Yes, you. Anything. I don't care what it is. Any problem you have, so you buy this property, obviously, if it's a financial situation, mismanagement, or any type of anything of any sort, it all falls on you. Lack of credibility. It's not as it sounds, but the credibility comes from the credit standard. A lot of banks, things, when they look at this business and they say, so Shavonda LLC, that's just your name, Shavonda? Yeah, so it's you, not LLC, I'm sorry, Shavonda Designs, I apologize. This is Shavonda, is that you? Yes. Who owns the business? Just me? Oh, okay, yeah. We'll come back to us a little later. We'll, you know, we don't want to lend to you, right? In the mind's eye, a lot of lenders, they don't see a sole proprietor as a rural business. And self-employment tax. Yeah, when you work for yourself, now, I'm gonna do it this time. Self-employment tax, but it's 4%. All right, so if you work for your employer, guess what? You pay to, your employer's paying to. Okay, so when you look on your income, your W-2, or sorry, your pay stuff, that's what it would be. It's been so long since I have paid stuff. I can't, because I work with stuff. But anyway, your pay stuff, you'll see Social Security and Medicare, you see all that. Well, yeah, 2% of that you're paying, and your employer is paying the other 2. Guess what? When you are self-employed or sole proprietor, you pay all of it. Yeah. You pay 4%, you pay all of it. Now, just so that I'm not crushing the hearts of all of those who are listening to this, the state, the government rather, realizes that self-employment is an issue. And they also realize that it could be a really hurt piece for a sole proprietor or any business and have to pay that 4%, especially small business. So there are credits that the IRS will provide if you make under certain thresholds that can offset that expense. But nevertheless, it's not that it's a negative expense. I really want to mention that. It's not that it's a negative expense because let's face it, I'm not getting any younger. Any of you in the room getting any younger? Getting younger at heart, right?
She's definitely getting young. Thought she was.
Yeah, that's all right. Thought she was older. As we age and as we continue to put money in these pots, as it were, for social security, that money, so this 4% is actually money you're paying to yourself. So don't look at it as, oh, it just flies out of my pockets. As a sole proprietor, yes, you're paying the 4% self-employment tax. However, the money is being really paid to yourself. So for those of you, when you file your income taxes, I know this is not a tax course, but I am a tax preparer, so I want to just throw this little plug in there for you. When you are filing your income taxes, you're trying to minimize your self-employment tax. In essence, you're taking away your social security. So you might want to rethink that. Just a little tidbit. So let's look at our next one. All right, so you buy real estate and you want to do a general partnership. Now, general partnerships, it's a little advantages and disadvantages. So first of all, partnerships means we have to have at least how many people, folks? Have to have at least two people. Do they have to be related? No. Do they have to know each other? No. You don't have to know nothing. As long as you say, I want to go in business, you want to go in business? Hey, let's do this. And you can start a business. All right, so the difference though with the general partnerships is that each partner, when it comes to buying real estate, their information can either help you or hurt you. So, not to make anyone reminisce about any bad times they've had. But let's just take a moment. Let's just take. Now, when I was younger, I have two sisters. I have one younger and I have one older. All right. And I remember an instance where my mother said that she couldn't find something. So she asked, which of the three of us did? Of course, I said, I didn't do it. No one else? I didn't do it. I didn't do it. So guess what my mother did? She punished all three of us. Needless to say, I'm still traumatized by that to this day. Well, in a partnership, a general partnership, something similar. Everybody is punished for discipline, have a disadvantage when one person in the business don't have their stuff together. That's his baby. But you know, Kevin talked to us about business credit, personal credit throughout the months that we have had this segment. And for the most part, yes, each of us are responsible for our own good. But when you get into this type of business situation where you just decide to have a general partnership, you're really trusting this other person or people to bring all what they have together and you go into the business. So if they owe the IRS $10,000, guess who else owes the IRS $10,000? Yeah. Yeah. So pros, it's easy to become a partnership. Handshake, we have business. No, nothing real hard about that. You have to just have like minds you can work together and form a business. Don't need a whole lot of paperwork in that. This is a general partnership. It's great for married couples. My husband and I have been working together in business for over 20-something years. I wouldn't call our relationship a general partnership though, but it's really good. And also the IRS recognizes it as a joint venture. So you might have heard that term as well. General partnership, joint venture. And pros of general member. You can take someone in that, say, look, you and I, let's do business together. You know, I seem to be more savvy when it comes to this, that, the third. Do you mind if I be the general member? I'm the one that everyone comes to me. But I'm gonna talk to you. You could be like a silent partner, but everyone comes to talk to me. Everyone says, okay, yeah, because I don't want nobody talking to me anyway. Great. You're the fall guy. Everybody comes and talk to you, and then you come and bring the information back to the partnership. Some plus. Personal liability, as we discussed before. One of your members is a bad situation. Their situation is your situation. They're responsible for your debt and debt incurred by other parties. You get one of those net accounts, Kevin mentioned early, did you pay it on the 30th or the whatever day? Oh, no, well, well, guess what? All your credits free now. Because you didn't, because that's the arrangement you had. So when you buy a real estate, and you put in the business in the name, putting that as your entity of choice, when you're buying property, you can see how the different attitudes, feelings about the property could possibly become an hindrance to you when it comes to what improvements you want to make on the property, what if you want to sell it, if you want to take out a loan on it. So those are the type of things that you have to really take into consideration when you own a property as a joint venture. Okay, so we're going to look at our third one. And thus far, before I move any more, are there any questions that anyone has on our viewing audience or that we'll talk about a lot? Yes.
For general partnership, is there like, I know you mentioned 2 or more, but is there like a limit?
Oh, okay. The general partnership don't have a limit. It's just be general partner. You usually have, the recommendation would be, I've seen it, where you wouldn't want to have a lot of people. It's a general, but the thing about general partnerships, your partners can change all the time. You could be a partner today, guess what? You decide, no, I don't want you. It's easy to let a partner go in a general partnership. Yes.
What if your partner dies?
Your partner died, they're no longer part of your partnership.
So you're a one-person partnership?
You're back to being a sole proprietor. You have to have more than one party in order for it to be a partnership. That's a general partnership. Let's go to our next one, which is also a form of partnership, possibly because as an LLC or a limited liability corporation, it is a business structure that limits the personal liability of the LLC member. So if you really think about it, this is where you start not being you. Just like Kevin mentioned, where on the credit side, you have your personal credit. Well, on the business side, you mentioned that that entity is being separated from you. So even if they use your name and your information as guarantors, it's not you. You're just a guarantor. So what I need you is to see it as is if I'm Abby in my business LLC, a limited liability corporation, as you all may know, is here. I'm not gonna write up her name. Abby is me. I'm an entity in the eyes of the government. IRS views me as an LLC because it is established. State is viewed as another entity. That is not me. All right. So, since the LLC is not me, it's by itself, it's separate. It has bylaws, it has operating agreements, all those things we'll discuss in a minute. It separates me. So when I want as pro legal protection, then someone says, I'm gonna sue Abby. Okay. You can sue Abby, Abby don't have nothing. But you're gonna get Abby. Sue her. Not encouraging, just let you know. But the LLC, you might say, all my assets, all the things like my house, if I'm gonna buy a house, I don't want it under my name as Abby, because if someone sues me, they'll take my house. But if it's under the LLC's name, then it gives me the legal protection to hold on to my assets, because it was Abby that you was trying to go after, not my LLC. Okay. Another pro is a limited liability company is it never ends until you end. It always exists. Unlimited lifespan. Abby, I don't have unlimited lifespan. I want it, and I'm sure it's gonna come. But right now, my LLC, as it stands, will outlive me. So because of that, it's important for the persons to think, especially in African American communities where we often think sometimes a one and done type of mentality. Get rid of that. Get something that's gonna last you a long time. If you're a person that says, I want to start a business, I just want to, maybe that's a good time to start a business. And I'll tell you why. Tax flexibility. There's times I've seen when people come in and they're trying to prepare the tax returns, things, they owe so much money on so many things because they own it in their name. They own the property in their name and they have all these different expenses and expenditures, whereas if they own the property as an LLC or company, then they get some benefits. Because now it's an investment property, it's not a personal. All right, so the different laws that are in place for LLCs or limited liability companies are really good. Really good. Now, the con, all right. Anything that's worth having, there is like you need to have some structure. So the state allows LLCs to have what's called operating agreement. Operating agreement is flexible. However, it's a con in the sense that I have here that the analysis of it, because people have things going on in their lives, so you might have designated me to handle marketing in my operating. I'm the marketing. But perhaps maybe because of other responsibilities, I don't have the time to invest. So now I have to analyze my operating agreement and say, okay, we can't have Abby doing marketing, but perhaps she could do this. Okay? So you constantly always have to look at your operating agreement to see how your LLC is operating. That could be a con for something. As we mentioned in the other two, with Mr. Sole Proprietor or partnership, don't really have all those little details there. It's kind of like you do this, I do that, and you got this understanding. With an operating agreement in the LLC is a little bit different because everyone is dependent on the person to handle certain things to keep the LLC functioning. And the infrastructure changes with the LLC can be somewhat frustrating because you can have a vision of your company going a certain direction, and then someone else in your LLC might see it differently and want to try to go this way. So what are you going to do? You know, when it comes to buying real estate, you want to buy, you want to sell, you want to hold, you want to rent. So all these types of things are what you got to think about when buying a property as LLC. However, if you notice, a lot of investors all the time always buy the properties in the name of LLC. Even if the name of the street is, you know, ABC, they always say ABC LLC. You'll see that all the time because that LLC is specific to just that property, that particular property. So you can have LLC, you and I, all of us in this room can form an LLC together and buy this house, and the LLC will own that house. And then we all can say, okay, based on our operating agreement, we all want to get 30%. The other 10% can be, let's say, we'll leave that into an account that will help take care of the property. At the end of the year, each of us will get what's called K1. With our 30% of how much we earned on that particular property, and you file that K1 with your individual tax. That's how that's done. Okay. So an entity, just remember, just to reiterate, is not you. So whenever you fill out any document, any paperwork, whether it's insurance, whether it's the agreement to sell, mortgage, everything is applied through the LLC's name, LLC's EIN number, everything is associated with the LLC's banking account. So, and that's another thing. I had someone tell me just the other day that they have a business, but they have not yet had a bank account. You don't have a business. If you have a budding business, first thing all should do is EIN number, your LLC. And go and put $1 in the bank. Okay? All right. So, are you in questions? No questions? Oh, that means I'm bored. Good. All right, let's take our last slide. Just in general, asking questions is important. You have to plan. Plan. I can't stress this enough. If you buy a house in your name, Abigail Bridgeford, and then I decide, wait a minute, I want to protect this asset, not necessarily for my children, but I just might want to keep a certain amount of assets over here. Maybe when I'm planning to retire, which I am planning to retire for you. I may want to change it from Abigail Bridgeford to my LLC. Every time you do that, it's 2.14% transfer tax. So can someone engage me, and let's do a little math project here. Let me say if I have a property that's $200,000 and the transfer tax is 2.14%. Can you give me the answer for that?
1.3%.
So it's 2.14%.
The total dollar, $4,000.
That's the transfer tax. Yeah.
4,280.
Okay. So on that example, it's $4,280. For me to take it out of Abigail Bridgeford to move it over to Abigail LLC, I gotta pay the city $4,280. If I had planned it, I had just took a moment before when I'm buying my property and say, you know what, I don't want this to be a property that anyone really knows that I personally own. I want to put this, I want to have myself a portfolio of properties. If I just took a moment to plan this correctly, I can say, well, let me spend about $350. I'm a form an LLC if you don't have those. This is cost center. All the expenses associated with starting the business, the situation. And I'm going to buy my property as Abigail Bridgeford LLC. I saved myself $4,280. Do you know how much the city is making off of these houses with companies doing things like that? The city is racking up a lot of money because people make decisions and not me. I want you to sit down with your families, your loved ones, your business partners in the life and say, look, what are we trying to do? What is our goal? How should we go? We should go into this long term. Think long term. If you don't have children, then you might not want to necessarily put it in the business. Or if you do have children, you still might want to put it in the business. There's people who have things they don't want to leave to their children. Obvious reasons, perhaps children's not responsible enough, or whatever the case might be. But you might have something else in line for your children. Maybe your children don't want a house, they already have their own house. But the point of the matter is you have to plan. You have to talk to a real estate agent and let them know. I know a nice real estate agent. Let them know what your goals are, and then they can be able to advise. And at this time, I'll open for questions. You seem to have a question, yes.
I do. For a hypothetical situation.
Hypothetical situation.
Say somebody wants to start an interior design business.
Right.
But they like the pros of the LLC, but they don't like doing a lot of paperwork.
Well, there are a lot of companies out there. I myself have used one. Send them a few dollars and they can form your whole company. And I think, Kevin, your business, your office also.
We do it as well.
There's a lot of different companies who that's what they do. They help a lot of people. I've started over like 4 or 5 businesses myself. So utilize the resources of people who, some people they enjoy doing. You might not like it, but they enjoy doing. So for those who didn't hear the question, what if you're a person who wants to start a business, but you really don't know where to start and you don't want to do all that yourself? then you can always utilize the services of other companies who form both business. And first and foremost, really think about what type of business you want. But the LLC is the most popular when it comes to want to protect your, because that's why it's called limited liability. Liability doesn't really fall on you personally. It doesn't fall on anybody as individual. That's why that entity is protected. And those within that entity gets that protection. And if there's any type of liabilities, then individually, when they file their own tax returns, and when they do their own things, that they'll get that, they have to pay penalties or whatever else associated with that. But then too, a limited liability company, as Kevin mentioned earlier, when they go for vendor accounts or any other accounts, it's all going to be based on the performance of that company. So as a business, as a company, it behooves everyone to do their best so that the company. So see, no one's going to start a business and not want it to be good, not want it to prosper. You know, and just so you know, IRS consider you a viable business if you have any profitability at least 3 out of 5 years. So if you're a person that says, I have a loss, I have a loss, I have a loss, I have a loss, guess what? Those 4 years out of 5, you have a loss, you're not a business, you're a hobby. You know, and IRS won't, the IRS is picking up on people who say that they're businesses and they're not. You don't want to buy real estate as a business if you really don't want to be fully invested in that property. Because even businesses, properties to sit there and be, you know, for years and years and years. The state taking business properties from businesses too. Big foreclosure on businesses too. So next week, when we look at our next slide, next month, I'm sorry. We're going to be back here again on October 13th. And Kevin's going to discuss business merchant accounts. And I'm going to talk to you a little bit about investment real estate, which is what a lot of people are very interested in. And we have our personal information here so that if you want to call us at our offices, you want to go on our website for getting additional information, or if you just want to shoot us an email, we welcome any critiques and comments and concerns. We take them all that you might have. And we look forward to seeing you all next time.